Thanks very much. Yeah, I'm CEO of GLI Finance. We're AIM listed, have been since 2005. I've been in the business since 2009 when I was brought in by shareholders to sort out what was a business which had lost at that stage 96% of its value. It's now regained about 50% of that, so we're up about 15-fold from the lows. This being what our lawyers like to put in means you shouldn't pay any attention to anything I say today. So anyway, what does GLI do? We provide finance to businesses around the world, small businesses, in a way that the banks no longer want to, either because they can't provide it or because they won't provide it. They can't provide it because it's a type of finance which requires a lot of input in a way which would be difficult for them to do through simply a computer says yes, computer says no, requires a bit of human input, requires some due diligence. Or they won't provide it because of the amount of capital that they need to put against the business now with the introduction of more stringent capital requirements. We provide this finance on 3 continents, in Europe, in the US and in the UK, in Africa. In the UK we have 10 platforms, and then we've got 5 in the US and we've got 3 in Europe. We've got a small West African business as well. And we provide the finance in different forms. We can basically provide almost any type of finance that a small business would want, whether it's invoice finance, trade finance, supply chain finance, bridging finance for property, or what most people would regard as SME finance being standard term lending. Importantly, one thing we don't do is any consumer finance, and that's quite a deliberate policy. I took a decision very early on as we started to migrate this business from where it had been originally, which was in US middle market loans, which is where it was when it had lost 96% of its value. We didn't want to get involved in consumer lending. The reason for that is that in the alternative finance space that we find ourselves, if you're dealing with consumers, you will be dealing with subprime consumers. If you're dealing with subprime consumers that you're providing finance to, you run the risk of the regulators or the politicians or both suddenly deciding that in fact what has been standard market practice in the past is now frowned upon and you'll get a big regulatory fine. The banks can absorb this. If you're a small alternative finance platform, it might be more difficult. So we don't like the potential regulatory risk within consumer, so we stick to SME. How do we actually lend the money? The way that we lend the money to small businesses is that we have equity stakes in 19 different alternative finance platforms around the world. We then buy loans from those platforms, both on our balance sheet, and we manage other people's money in the loans that are originated through those platforms. Because we have stakes in 19 different platforms around the world, we have more stakes in these businesses than anyone else that is interested in alternative finance, and so we're very much at the heart of the explosive growth that there is within the sector. We're averaging returns of 10 to 11% on the loans, and the sector as a whole is growing by between 5 and 10% a month. So there's decent growth. The reason that it's growing is because, as we all know, banks are not as keen on financing businesses as they used to be. The growth last year was 161%, and this year we'd expect something similar. But importantly, this still represents a very small part of the overall lending universe. The analogy I use is that it reminds me of the type of dynamics I saw 30 odd years ago when I started as a fund manager, And my chief investment officer at the insurance company I was working for couldn't understand why it was people kept trying to get him to employ an investment manager to look after emerging markets. Because at the time, emerging markets were less than 0.5% of global market cap, and as far as he was concerned, this was a complete irrelevance. What he was missing was that emerging markets were growing very rapidly, and developed markets at that time weren't really going anywhere, and so he was missing out on a lot of performance. In the same way, you've got the same dynamics with alternative finance. Small part of the overall market, large potential to grow. It's also got a lot of support, and this is another reason why we think SME finance is interesting. It's got a lot of support from government. So in the UK, the British Business Bank has been instrumental in helping these SME finance businesses to provide finance into the businesses that need it. So we work with the British Business Bank. They provide some match funding for one of our platforms, and they're very interested in how else they can help fund it. There are other similar organisations in other jurisdictions that are either already working with SME finance organisations or looking to do so in the future. One thing that people always ask about alternative finance platforms, and particularly peer-to-peer businesses, which is part of the overall universe, is it regulated? And the answer is partially at the moment. One of the problems with regulating alternative finance is to actually understand what type of business it is depends on where you're looking from. And the analogy I always use is it's like a problem that there is in quantum mechanics, that subatomic particles look different depending on how where you're viewing them from. And in the same way, an alternative finance business looks different depending on whether you think it's a technology company, whether you think that it's an investment company, whether it's a lending business. And all of these need to be regulated in a different way, and the regulators are not quite sure how to combine them into one. In the UK, we have regulation of some platforms, not all. We'd like to see all of the platforms brought into regulation. In the US, very little regulation at all. And in Europe, broadly, the regulations are being brought in to adapting existing financial regulation. The European regulators are in an easier position because they tend to have already been regulating SME finance anyway, whereas both in the US and the UK, financing small businesses has pretty much been an unregulated business in the past, and hence you've had some issues with things like mis-selling of swaps, which have been very difficult to deal with because there was no regulation. We do work with regulators around the world. It's something which is a very important part of what we're now doing, having built a global network of platforms, that we need to work with the regulators to ensure that this business is properly regulated. So we'd like to see more regulation, but at the moment it's only partially regulated. What does the future hold? Well, the alternative finance sector has grown up as primarily originally a peer-to-peer model. The idea was that you were going to get a vast number of people that were going to provide the lending to businesses and to consumers. The investors were going to benefit from getting a good return. The borrowers get funded in a way that they couldn't have done previously. However, what has happened is that as institutions increasingly become interested in investing in this as an asset class, so what you find is that these platforms are becoming more direct lending businesses, by which I mean rather than having a wide range of investors, they have 2, 3, 4 institutional investors that provide all the lending capacity. And that means that the cost of getting that funding is a lot less than if you're dependent on a wide range of investors. It also means it's more dependable. If you've actually got an institution that's looking to strategically put hundreds of millions of dollars into this as an asset class, they will be there buying those loans, every month, month on month, regardless of what happens in the short term to economic conditions, regardless of whether the Chinese stock market is blowing up, they will still be there buying. And so you've got that dependable lending capacity, which you don't have with a peer-to-peer model. Peer-to-peer model, there is a risk that if you see a major blow up in markets, investors will stop buying. If investors stop buying, you can't fill any loans. Much less risk when you've got a direct lending model. But in time, I think what these businesses will do is they will develop to more balance sheet businesses where they're actually getting the funding for the loans on their own balance sheet. And the reason that will happen is that banks are becoming increasingly interested in providing funding for these businesses. So if you've got a loan which is costing a company 10%, which at the moment you are effectively selling to an investor for 8.5%, say, and taking a 1.5% margin, which would be a typical economic model for the platforms. If instead a bank comes along and says, we will fund the business at 4% or 5%, you've suddenly got a much bigger margin that you can take yourself, and so it's worth taking the credit risk. So we think that the businesses will gradually move to more of a balance sheet focus in the future, much like aviation that was presenting previously. Importantly, from our perspective, we're agnostic as to which model a business takes. We have some peer-to-peer lending businesses where we're providing lending alongside a wide variety of other lenders. We have some direct lending businesses where we work with one or two outside institutions to provide some of the lending. And we have some balance sheet businesses where we're providing all of the lending capacity. So we can put money to work across any model. We don't have to try and convince a platform that they've got to remain a peer-to-peer platform. We can invest across all of them. And we can also look at other areas that are related to what we're doing that we can benefit from because of our strategic position in the sector. And the example I've used here is neutral platforms, platforms which will allow an SME or an intermediary of an SME to find a source of funding. And we have a couple of those in the UK that we've invested in. It's a related area, but it's part of the SME finance value chain, which we've been able to get into because of our strategic position. And I think over time, as this becomes an essential part of the financial ecosystem, so gradually the alternative out of alternative finance will gradually fade, will just be seen as a finance business. We have a very strong management team that's growing all the time. That's a function of the fact that we are now very much a grown-up business. Increasingly, we're having to spend our time on glorious things like risk and compliance, because I think it's an essential part of what will be a key differentiator within the industry, whether these businesses see themselves as finance companies or whether they see themselves as technology companies. We see ourselves much more as a finance business. We're developing a strategy to utilise third-party capacity through our platforms. The first thing that we're doing is a closed-end fund, GLI Alternative Finance, which is a closed-end fund where the initial launch will be closing next week. We will be launching a series of further funds off the back of that. So increasingly, as we move forward for GLI itself, the revenue from the asset management business will become a meaningful part of our overall profitability. These are our platforms by type of lending and by location. As you can see, a wide range of different types of lending, from standard term lending through short-term finance and working capital solutions, and across from UK, Europe, US. In order to pay our dividend, and we pay 5p dividend, which on a share price in the low 50s is not too bad. We are moving from just being ordinary share funded to having some zero dividend preference shares and ordinary shares, which will significantly increase our dividend cover. The guidance that we've given the market for some time is that we would like to see in the long run a balance of 70% ordinary shares, 30% zero dividend preference shares. And that should get us to a position where we'd be at least comfortable with the current dividend, and prospectively we can look at some dividend cover in the future. So in conclusion, we've got a business which we think is positioned to be the diversified growth play in the alternative finance sector. We've done a lot of balance sheet work over the past year, and we're now in quite an interesting position. All of the platforms are starting to originate material amounts of business now, and we think our in-house asset management business will be quite an interesting revenue growth opportunity for the future. Thank you.